Mr. Ribello, great to have you today on ET Now. Thank you so much for your time. Let's welcome on board then Sandeep Sabharwal and ask him what is his opinion on the market. Sandeep, hi, good morning. Great to be speaking with you as always. Sandeep, today it's going to be about Eternal and Maruti, I guess. While for Maruti, brokerages are penciling in a very strong revenue growth of about 27%. We already know what they've been delivering in terms of, monthly sales numbers. But what about the commentary, Sandeep, on how they will grapple with input cost pressures?
I think there are several issues facing the industry. Although long term, I'm bullish and we do hold stocks like M&M, Maruti, and Bajaj Auto. But I think near term, there could be issues because of the fact that, like you rightly said, input prices, especially steel prices, are shot up. So in this quarter, we might not see as much impact because of longer term contracts. But I think going forward, there could be some impact of that. Then there's although fuel prices in India have not gone up till now, we don't know what's going to happen after the state elections. And psychologically, although long-term holding-wise, fuel prices don't matter much to the holding of a car or a vehicle, psychologically it does have an impact on consumers. So, and post GST rate cuts, we have had a very strong run. So it was expected that this will sustain, but I think whether this sustains or there is some impact of that. So all those things we have to see. So I think the auto industry, the stocks are not very expensive, the large cap auto stocks still, but near-term concerns are obviously there.
Deep curious to know, and I want to quickly plug in AU Small Finance Bank's numbers while I ask you this question. Some of the small finance banks, really the numbers are extremely strong. Even NBFCs, we just spoke with M&M Finance. The guidance seems to be strong. The confidence seems to be coming back. Are you betting on any of those small cap lenders? Very quickly on AU, they've hiked their ROA guidance FY26 versus FY27 from 1.6 to 1.8. Growth continues to be extremely robust. Credit cost guidance trimmed to 0.9% for FY27. So some of those levers really helping in terms of the FY27 outlook. And typically what we've seen is that they're quite conservative in their guidance as well. But stock trades at 4 times trailing 12 months.
So there are two things. I think from whatever you said, it doesn't seem to be a conservative guidance. I think it looks to be an aggressive guidance at a time when there could be some stresses in the pockets in which they actually focus on lending. So that's one part of it. Secondly, obviously, like you rightly said, that it's not a cheap stock. So I would say that in an environment where the economy could potentially slow, we need to hold more conservative financials. So on like you were having this discussion with M&M Financial, and that's a stock we've been holding. So that's a company which is conservative. Like they are not giving any aggressive growth guidance, despite the fact that they have done extraordinarily well and exceeded most expectations. So I think some caution is warranted by financials, NBFCs, banks in lending when there is some outlook or that there could be some potential stresses. And because the reported profits matter very little in financial, it's the asset quality. If you're able to maintain asset quality and potentially improve it in times which are slightly stressful, then you actually end up generating wealth.
Sandeep, over the past 2 weeks, we have seen the mid cap and the small cap outperforming the broader, the benchmark indices. Do you think that, now it's a time to cherry pick companies where there's growth coming in and, start investing? Because these indices also are giving a higher returns compared to the benchmarks.
So not to follow what has happened in the near term, but if you look at the way the large cap results have been coming out, and like you rightly said, some mid cap results, and the fact that the mid caps as a broad category saw significant correction from September 2024. So there is opportunity to, I would agree, cherry pick more on the mid cap side, maybe some selective small caps, rather than the current consensus sort of view that large caps will do better than mid caps.
Uh, Sandeep, just hang on there. We'll go into a short break and come back with more. Stay tuned.
Welcome back and thanks for staying with us. Let me, in fact, also quiz Sandeep Sabharwal with regard to a couple of earnings which came out, and Coal India was one of them. Sandeep, Coal India structurally the volumes were higher. E-auction realizations were largely softer than expected. You expect that to really start kicking through starting Q1 FY27? Is that the best way to play the summer, at least with regard to India, or would consumer durables be opaque, or how would you play that?
Yes, I think some of the consumer durable plays, which are summer plays, could actually do well. Initially, these stocks went up, then they corrected when the summer didn't start, like the summer got delayed, and now we have a scorching summer. So I think there's been some cyclicality, but obviously companies with focus on ACs, fans, coolers, etc. I think they'll do very well this year. Coal India specifically, I think it's a company which is not very expensive. Dividend yield is strong, and to that extent, I think those are the things which you can look at if you want to own the stock per se. Like in terms of trying to increase the volumes of production, or the fact that they have not been able to hold their guidance of production and sales like over the years, like largely, is something which you need to factor in. And obviously, they are not able to increase the prices in line with the way the international coal, coking coal prices, etc., are increasing, and their input costs could potentially go up. So that could stress profits in the short run, but that's true for most companies. But I am not such a big fan of like Coal India.
Okay, not such a fan of Coal India. Eternal, that's going to be the other one, which is going to be on everyone's radar today. The net profit, of course, is expected to be in the to surge about almost 263% on a year-on-year basis. Brokerages are tracking a very, very sharp recovery in the profitability, and they're pegging hopes high on the food delivery growth and, of course, Blinkit's e-com momentum as well. The consolidated revenue is seen rising about 7.5% on a sequential basis, but the biggest watch point is going to be Blinkit's growth trajectory and the management's first formal FY27 guidance under the new CEO, Albinder Dhinsa. Remember, Zomato almost cracked all the way to 220-odd levels when Dipinder Goyal actually stepped out. So this is going to be the first earnings announcement under Albinder officially taking over the helm as the CEO. Kunal, you've been mapping the charts of both Maruti as well as Eternal, right, for a while. Tell me, what do you see on them ahead of the numbers from both these majors today?
See, I think it still whiffs off that the traders are a little bit skeptical in going into the results for both of these stocks because, for example, Eternal at 250-55 levels where it's trading right now, it's still not broken past about the first major resistance. And remember, Eternal is a high beta stock, and the stock had fallen very sharply from 350 levels, I think, 3-4 quarters back towards 220-215 mark, which is the low for Eternal. So after almost like a 40-45% correction for the stock price, it's not bounced back in the same manner in which probably many of the mid-cap names which have corrected by 30-40%, these stocks have. So that tells you that maybe these stocks are going into their earnings season with some bit of traders maybe sitting on the fringe or just waiting for the results to pan out and then try and take positions into these names. but that would also probably keep the stocks a little bit more volatile going into the results, because if in case the results, for example, surprise on the positive side for both of these names, Maruti as well as Eternal, you might probably expect that both of these stocks would probably try and play a strong catch up for themselves. So that, I believe, could probably be a very good positive. So which means that if in case the results come out on the positive side, the price action is positive, these stocks break their, say, immediate swing resistance. For Eternal, for example, that's around 260, 265 levels. For Maruti, that could be around 13,500 plus mark. If these levels are taken out, then I would believe that that could throw a very good opportunity for even swing traders who are looking out for, say, a quick 5% to 10% upside into these stocks to enter into these themes.
Sandeep, auto, Eternal, would any of these sectors, pockets at all interest you at this point?
So Eternal, I think we need to see how the quick delivery business is doing and the profitability maintenance there versus the cost increases. The other factor at play for Swiggy and Eternal both is that Amazon is now getting aggressive on the quick delivery front, and they have announced plans to get into the top 100 cities. So how will that have an impact on the businesses of Swiggy and Eternal, which have been loss-making, where they have been trying to turn them profitable, but then one big competitor becomes more aggressive on that front? How does that impact them? So I would think that upsides in these stocks could remain capped for now.
And I'm curious to know what you make of Sun Pharma as well. Give us a sense of this huge acquisition, and how do you view it?
The initial market reaction has been positive. The only things we need to see is that, it seems to be a good fit for Sun Pharma in terms of the company they acquired. The only factors we need to keep in mind is that they've actually paid almost double of the stock price what was there few months back. So the acquisition is not cheap, although on a sale, like on the matrix of enterprise value to sale, all those factors, it looks cheap, but then it also has debt on its book. Large acquisitions by pharma companies, if you go back historically on all the large acquisitions which have been done by pharmaceutical companies, they have not been easy. Like, it's not been an easy consolidation. It's taken time. So I would think that we need to wait and watch. I don't think it will be such an easy integration.
Seems to be the case.